Hello traders, this is the Zigzag Man, and this is part 4 of the series of lessons on support and resistance at the middle Bollinger Band. So let's begin with CIGX. Even though I recommend trading stocks with at least 1 million shares traded per day and roughly in the $10 range, a lot of my students have requested once in a while I do a video on some of the cheaper stocks, the kind that they like to trade. And CIGX is a real good example of, first of all, it's a NASDAQ stock. It's not a OTC BB, which is bulletin board or over the counter. It's not a pink. I never talk about those. And it's got really actually decent volume. It looks like at about 1 million a day on average. A little less through here, but up here it's got 12 million. This day it had roughly 5 million when it bottomed. So let's start here. Okay? My students know that I like to buy at the lower Bollinger Band or just below it after a fall from about 80 cents down to nearly 50 cents here. It becomes very vertical here, straight up and down right here at the bottom. And as you can see, this red volume candle, it's a pretty big volume day, and tops and bottoms are for the most part called on high volume. So let's say you get in here at about 55 cents on the CCI buy signal. When the CCI drops below the -100 line and then crosses back up through it. Now Stochastics also, it's great if it gets below 20 and the black fast line crosses up through the slow line. The MACD wasn't much help here. As you can see, the MACD itself, the black line, the fast line was still down ticking, and so was the red slow line. But let's just go on the buy below the lower Bollinger Band. You're in at 55 cents. The CCI gives the buy signal, and it takes off at a fairly not very steep rate of ascent, and then it kind of curls down. Okay, now it had a nice bounce. This is an oversold rally right here. It bounces up to about 73 cents or so, maybe 75 at the high there. And as you can see, the dotted blue line is the middle Bollinger Band. Now, as I teach, if it breaks through the middle Bollinger Band, there's a real good chance it will go up to the upper Bollinger Band. Most of the time it will. So you're in at 50. You buy this day and you look at where the upper Bollinger Band is. It's sitting up at 90. So let's say 55 to 85. That's 30 cents with 1,000 shares. That would be $300 if it goes all the way to the upper Bollinger Band. But what happens is it's got a white candle that closes near the high of the day, a gap up the next day with a taller white candle closing very close to the high of the day, but then you get a black bodied doji with a small body, an upper and lower wick. This next day was even a better doji with a tiny body and a pretty tall upper and lower wick. These can be reversal signals. Now he looks like he unchanged the next day, but he tried to touch the upper Bollinger Band where resistance can happen quite often. And when that happens, the CCI will not be able to break through the 0 line. Stochastics will not be able to break through the 50 line. So you're in the trade. When he gets up to the upper Bollinger Band, or the middle Bollinger Band, you're looking for reversal signals. You're looking for the CCI to down tick a little here and not go straight up like it did on this one. Okay, so you know he's having trouble. When you buy and the CCI goes up, at not a very sharp angle of ascent and then levels off, that's not a good sign. Okay, so a couple of days later, he did go up and almost touch the upper Bollinger Band. Okay, but at that point, the CCI started to downtick fairly sharply. You got the fast line of stochastics breaking down through the slow line. So my whole point about the middle Bollinger Band is you get in a trade and you want to take profits here at the middle Bollinger Band because it's obvious he's not going to go to the top. You've got a bad takeoff on the CCI and didn't get to zero. You got a pretty decent angle of ascent on stochastics, but he couldn't even get to the 50 line. Okay, so look what happens here if you didn't take profit. 3 days later, you're back to your buy price. Okay, so that's the whole point of this lesson, is how important it is to realize what kind of resistance can be met at the blue dotted line, which is the middle Bollinger Band. There is no point in buying here, getting rejected at the middle Bollinger Band, the CCI getting rejected at the 0 line, and stochastics getting rejected below the 50 line, and then letting it go all the way back down to your buy price, and actually a little bit below here, which is actually another buying opportunity. Okay, so if you get in and it gets up to the middle Bollinger Band and starts getting turned back at the 0 line of the CCI and the 50 line of stochastics, go ahead and take your profit. You're in at 55. He gets up to 65. That's still $100. There's no point in going back to zero profit or a loss. You know it's going to fall back to the lower Bollinger Band. Then you're looking for the next buying opportunity, which comes right here, right near the lower Bollinger Band. There's no volume, but you do get the CCI buy signal. Now volume starts picking up the next couple of days. The buy signal's right here, so it would be on this white candle day you'd probably want to get in. Okay, and like I've said in the other 3 lessons in this series, that what you're looking for, if you miss the bottom, what you're looking for is a nice straight line right up through 0 of CCI. You're looking for a nice, the CCI has to drop below the -100 line and then cross back up through it. So there's your initial buy signal. You could take half of a position there, wait to add more when you see this CCI breaking above this level of resistance and busting right up through 0, and as he's doing that, he's going to be busting up through the middle Bollinger Band. The other secondary buy signal is when stochastics breaks below 20, the fast line crosses up through, which comes just a little bit earlier than the CCI buy signal, but as it breaks through oversold condition at 20, the black line is already above the red slow line, and it's got a real sharp angle of ascent. There's no stalling here this time at the 50 line of stochastics. He breaks above this level of resistance. Okay, so you can take half a position at the lower Bollinger Band, just in case he rolls over at the middle again and drops to new lows. But as soon as you see him breaking through the middle Bollinger Band, you know he's going to go up to the upper one. The CCI tells you that. It's breaking up through 0, and it's headed up to the +100 line. The stochastics is breaking up through 50, and it's going up above the 80 line. So right here you're in at about 50 cents, 52, 53. He runs all the way up to over 70 cents. So in 1, 2, 3, 4 days, maybe 5, you sell the day he breaks above the upper Bollinger Band. Okay, so in at 55, out at 65. With just 1,000 shares, you've made $100 in 4 days, 5 days. Now if you had 5,000 shares, that's 20 cents. That's $500. or no, that's $1,000. 20 cents times 5,000 shares is $1,000. And 5,000 shares of a 50-cent stock is only $2,500. So for $2,500 investment, you've made 1,000. That makes your 2,500 turn into 3,500. Okay. Now, because this was so steep, it went straight up without stalling or all white candles. That's a pretty vertical move. I always teach to sell just above the upper Bollinger Band. Or you could wait. You could know he's going to pull back and find support this time at the middle Bollinger Band, because as you can see, Stochastics never broke below 80 here. And the actual sell signal didn't come until here, but I'll cover that in another video sometime. Even from here, you're in it 65, he runs up to 80. That's 15 cents. That's 150 with 1,000 shares just on that run. Okay, so he hits the upper Bollinger Band again, starts pushing it up, but then he has a big red day. As you can see, he falls, he breaks below the middle Bollinger Band and falls to the lower Bollinger Band, like it always will. There was your sell signal. The stochastic sell signal came when the fast line crossed down through the slow line and then broke below this green line of support. And then it went straight down. It had a little bit of support here at the 0 line and at the 50 line of stochastics, but then it broke down through it. As soon as it breaks down through the middle Bollinger Band like it did that day, you know he's going to go towards the lower, and then you wait for your next entry. And here it is. You buy at the lower Bollinger Band. There's the CCI buy signal when it drops below -100 and crosses back up through it. Stochastics is way below 20. Fast line crosses up through the slow line and breaks above 20. Okay, so he goes straight from the lower Bollinger Band to the upper and then back down. That's why it's so jiggy right in here. He had resistance at the 50 line of stochastics. He did break up above 50 here, almost to the +100 line, but when the Bollinger Bands start pinching like they do with the purple arrows, when the Bollinger Bands start squeezing together real tight, that's telling you a big move is about to happen. And it doesn't say which way, it just says a big move is about to happen. Okay, so you could wait until he starts closing above the middle Bollinger Band because it's bullish. All of these days starting right around in here where he's above the middle Bollinger Band and starting to move up. Okay, then you start to see a surge of volume. Now a CCI buy signal can also be when the CCI crosses up through the +100 line, especially when the share price is above the middle Bollinger Bands and you start getting big buy volume for a number of days. Okay, at that point right here, stochastics is breaking above the 50 line and this previous level of resistance, and the CCI is breaking up above this dotted red line of resistance. Okay, so you're in just because he starts closing above. You're in because volume is picking up dramatically. He stays above the 5 MA the entire run, so you stay in. That was a scary candlestick that day, but as you can see, volume started picking up dramatically. He did give a sell signal right here on the CCI, but stochastics never broke below 80. He never closed below the 5 MA. Let me verify that. I drew this 5 MA with a dotted blue line. He never closed below the 5 MA from the time you were in here until this big red candle day. Okay, so you're basically in all the way until this red candle day right here, the couple of days after the blow off top volume. And one of the reasons you get out is because this is a nice move here, but then he goes vertical. He goes straight up and down. These 2 days are straight up and down. Then he gets a candlestick here, which is called either a hanging man. It's kind of an inverted hammer. That can be a reversal signal. And then he closes below the 5 MA on this day, clearly. Right here, he's closed below the blue line, the 5 MA. Now, sometimes it's just a quick pullback. I'll get to that other chart in a minute. There was no breakdown of support throughout that whole area. He only just for 1 day crossed down through the plus 100 line of the CCI, but Stochastics never broke below 80. And as you can see, even as this was going down, you had a divergence. The CCI was headed down, but Stochastics was headed up at the time. And you also have to look at the MACD. The MACD buy signal came when the fast line and the slow line and the MACD crossed back up through zero right here as he's breaking up through the 50 line of Stochastics and above this resistance here on the CCI, giving a secondary CCI buy signal by crossing up through the plus 100 line on very good volume. Okay, and I teach to sell on the blow off top volume day because you were in here at 70 cents. He's way above the upper Bollinger Band here between $1.70 and $2.10. Okay, now the stock cannot survive for very many days. A candlestick cannot survive many days that far outside the upper Bollinger Band. The only thing it can do is run sideways to get back in or drop back in the upper Bollinger Band here, which is exactly what it did. So you're in at 70, you sell at $2, that's a $1.30 profit. With just 1,000 shares, that's $1,300 profit from the middle of February to the middle of March. That's a pretty good score. Take your profits, because a lot of times when a stock goes this vertical, he will give it all back to the middle Bollinger Band. Instead of taking your profits at $2, you're taking it at $1.19. So you've missed $800 right there. It's given it all back. Okay, you can see the CCI was down ticking sharply, and Stochastics looked like it was going to break below this green line of support. Now the MACD looked pretty good. The histogram, the day of the red candle, took a pretty big downturn, but look how far above the MACD fast line is above the slow. And yes, there was a slight downtick here. Okay, but when a chart goes vertical, straight up and down, I always take profits because there is going to be a pullback. And like I said, it could pull all the way back to where it began, because there are not very many levels of support. There's one here at about 90 cents. Looks pretty strong there. But after that, it was just straight up. There's a little level of support here at $1.30. Other than that, there's two minor levels of support here on this chart. And that's scary. You want to, you always want to lock in profits. Sure, it can go higher. And sure, it can drop halfway back, 100% of the way back. Take your profits on the high volume blow off day when he goes vertical. Okay, he cannot survive outside the upper Bollinger Band. Now let's take a look at the next almost 2 weeks after I made that first screenshot of the previous chart. That was a 1 day pullback to get back inside the upper Bollinger Band. Yes, he closed below the 5 MA, but the next day he closed above it on bigger volume than on the day he had the sell-off, the profit-taking sell-off. You were out this day here, or at least that day on the negative candlestick at around $2. He fell all the way to 160. But the very next day, he had more buying volume than selling volume on the red day. Closed above the 5 MA again, closed it above it here, 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 and here. So basically, you're still in. Today's March 26th. Sure, that went vertical again. It went way outside the upper Bollinger Band. And look at the next day. He closed back inside of it. Actually, this day, the red day, he closed inside of it. Now, the next day, he got a big white candle. And if you measure the halfway point of this red body, the dark part without the tails, he closed just about at the halfway point of the red body, which is bullish. Now, the upper Bollinger Band says 275. So he can still be moving up. He's pushing the upper Bollinger Band up. He's still above the 5 MA. He's still closing above the 5 MA, even on this big red, high volume, blow off top, profit taking day. But you got out here at $2. He ran another $1. So where would you have gotten back in? Okay, I would have gotten back in if you had exited here at 208 or the black candle. Then he fell back down and you're thinking, okay, it's done. I would have gotten back in the very next day or the next day after, because he closed above the 5 MA again. Now, you could have waited for this big white candlestick on the biggest volume on this 3-month chart to get back in. You still would have been in at $2. You buy when he breaks above 208, which was his old resistance on high volume. Okay, so you missed $2. You're in at 209. He goes to $3 even 2 days later. Now, like I say, you sell on the blow off top volume day when he's way outside of the upper Bollinger Band. So from there, you've made $1. You've made $1,000 from this day, almost $1,000. You're in at 210. You're in at 220. He goes to $3. You might be out at 280. Let's say you got in at 210, which is where you should have been in, 209, a penny above this high, because at that point in the day, this is a daily chart, but at that point in the day, you could tell the volume was going to exceed all of this. Okay, so you're in at 210. Now, the next day, he closed at the high of the day. The next day, he opened here, fell all the way down. Well, actually, he opened here, went higher, and then fell to the low of the day and closed just above it. Okay, now if I was in at $2 with 1,000 shares at 210, and 2 days later I'm at almost $1 up, I take it. That's $800 or $900, even $500. You take it. That's a blow off top volume day. The next day the volume is not that great, but like I said, it's a fairly decent candlestick. It's fairly bullish. Now, if it had fully engulfed, if this white candlestick, if the lower body, this lower line right here, had been just below the body there, and the candlestick top of the body had reached above that point right there, that would have been a fully engulfing, and I definitely would have stayed. Okay. This whole time, he only closed 1 day below the 5 MA. So what if you took profits there? You want to get in when he breaks out to blue sky territory, breaks out to new highs on high volume. Okay, that's called a breakout of resistance on high volume, and it can be a dangerous play. You know, this has nothing to do with my buy at the lower Bollinger Band and sell at the upper. Okay, this is a breakout into blue sky territory where he's never seen clear skies ahead, and you know, at 209, 210 you're in. You could have even sold at the close the next day at 260, $500 in one day, 1.5 days. So That's about it. Just because you get out and lock in profits doesn't mean you can't get in again here when he starts closing above the 5 MA. If you miss this, get in when he breaks above old resistance on high volume. You know, the CCI never gave a sell signal. And just keep your eye on that MACD. It was clear the lines were never going to cross. The fast line was never going to cross down through the slow line to give the sell signal. When they're that far separated, and he consistently closes above the 5 MA from this point here, you know, middle of February, middle of March, a month and a half, never closing below the 5 MA except on one day, never giving the sell signal by dropping below plus 100. You know, he bounces up off of the plus 100 line right there. You know, so far above the 15 MA and the middle Bollinger Band. But it's always good to take profits, especially when he goes vertical like that. This is just too straight up and down. He's got to pull back. This was too straight up and down. He had to pull back. Okay. So even though my rule is to sell on the when the candlestick closes below the 5 MA, you've got to have confirmation on the CCI and Stochastics and the MACD. So you've got to combine everything here. It's not just about closing below the 5 MA. Okay, but the most important point I'm trying to make about resistance at the middle Bollinger Band is if you get in here and it does what I call a round top. It's kind of a double top where it goes up, down, up, cannot break above the previous high, down, breaks down through the neckline. You know, it's already too late to exit right here. I mean, you definitely have to be out, but as soon as you start to see this CCI down ticking, which is right here at the middle Bollinger Band, the fast line crosses down through the slow line, do not stay in the trade. This goes for any price of a stock, a $100 stock, a $50 stock, a $25 stock. You get in where you're supposed to, and he gets rejected here at the middle Bollinger Band, at the 0 line of the CCI and at the 50 line of Stochastics. It's time to exit the trade before you end up losing all of your profit. Right here, you're negative at this point. This is below where you bought. Okay, and then it could just continue to drop like a rock, and then you're negative. Okay, if you're in here, right here on this white day, you never let the share price, even if it goes up 1 day, 2 days, just barely goes up a little and then drops below your buy price. You never stay in the trade. You never take a loss. Okay, you're watching for that CCI to go straight up like it does here. This is perfect. Lower Bollinger Band to upper, right through the middle Bollinger Band, right through the 0 line, right straight through the 50 at a sharp angle of ascent. This is not what you want to see when you get in. You don't want to see the CCI break up. It's going straight up right here, and a couple of days later it's rolling over already. Okay, that's a danger signal. So take your profits. Always take a profit, even if it's on this day when he breaks the double top. A double top is an M. It goes up, down, breaks through the middle point where he had support here at 60 cents 2 days. You know, you're in at 52, 55. You made 5 cents if you sold right here. I try to sell when I see the CCI turning down, which would have been more like 10 cents. You know, you made 100 here. If you waited for the breakdown here, that's only 50. It pays your commission. There's no point in ever taking a loss. You want it to go straight up through the middle Bollinger Band to the upper. Okay, so if you're in at 55, the upper is at 85. You've made $300 in a week, just over a week, if he does go to the upper. You do not want to see this. Okay, and the CCI will tell you that. It just rolled over right there. That's where I sell. Okay. And that's the most important thing I can teach you, is to, when you get in, first of all, to never let it go below your buy price. The second thing is to take whatever profits it gives you. If he gets rejected at the middle Bollinger Band, the 0 line of the CCI and the 50 line of stochastics. That is not what you want to see. This is what you want to see right here. The buy signal straight up through 0. The buy signal straight up through 50. The buy at the lower Bollinger Band straight to the upper Bollinger Band. Okay? So that's about it for this lesson. And that concludes buying and selling, or support and resistance at the middle Bollinger Band. I want to wish you all happy trading from the Zigzag Man.